If you've ever applied for a mortgage, you've probably heard something like this. Rates changed today. Rates improved. Rates got worse this afternoon. But have you ever wondered who actually decides mortgage rates? Is it the bank? Is it the Federal Reserve? Is it the government? The truth is, mortgage rates are determined every single day by the bond market, and lenders simply price loans based on what investors are willing to pay. Today, I'm going to break down how 30-year and 15-year mortgage rates are priced daily, why rates change throughout the day, the role of mortgage backed securities, why your interest rate may be different than someone else's. And by the end of this video, you'll understand exactly how lenders create mortgage rate sheets every morning. Mortgage rates are not set by banks. One of the biggest misconceptions is that banks set mortgage rates. They don't. Mortgage rates are actually determined by investors in the secondary market. Here's what happens. When you take out a mortgage, the lender does not keep that loan forever. Instead, that loan is typically sold to investors in the form of something called a mortgage-backed security, also known as MBS. Mortgage-backed securities are basically bundles of mortgages packed together and sold on Wall Street. Investors buy these because they want steady income from homeowners making monthly payments. These investors include pension funds, insurance companies, hedge funds, banks, government entities, and the price those investors are willing to pay for mortgage bonds determines your mortgage rate. The mortgage bond market, MBS, mortgage-backed securities trade in the bond market every single day, just like stocks. But instead of stocks, mortgage rates are tied primarily to Fannie Mae mortgage bonds. For example, lenders price loans based on securities like Fannie Mae 30-year MBS. These securities trade with coupon rates such as 2%, 3%, 4%, 5%, 6%. But here's the most important part. These securities also have a price usually expressed like this: 101.25, 100, 99.50. If the price of mortgage bonds go up, mortgage rates usually go down. If mortgage bond prices fall, mortgage rates usually rise. So every day, lenders watch the live price of mortgage bonds. Every mortgage lender releases something called a rate sheet each morning. This is basically the menu of mortgage rates for the day. It shows things like a 30-year fixed rate, a 15-year fixed rate, discount points, credits. But how do they create it? Here is the process. Early in the morning, lenders look at the current market price of mortgage-backed securities. Let's say the Fannie Mae 6% MBS is trading at 101. That means investors are willing to pay 101 cents for every dollar of mortgage bonds. So if a lender originates a loan at 6%, they can sell it into the market for about 101 of its value. That extra 1% is used to cover things like loan officer commissions, processing, underwriting, company profit, hedging costs. This is why rate sheets are built around bond prices. The par rate is the rate where the lender neither charges points nor gives a credit. Example, a 6.25% might be par pricing, but maybe 6% costs 1 point, but 6.5% gives a credit. This happens because each rate corresponds to a different mortgage bond coupon. Why 15-year rates are lower. The reason 15-year loans usually have lower rates is because they are less risky for investors. Think about it. A 30-year loan takes 3 decades to pay off. During that time, borrowers might refinance, borrowers might sell, borrowers might default. Investors face more uncertainty. But with a 15-year mortgage, the loan pays off twice as fast. This means less risk, faster return of money, more predictable cash flow. Because of that, investors accept lower yields, which means lower interest rates. That's why you typically see a 15-year mortgage rate about 0.5 to 1% lower than a 30-year loan. Mortgage rates don't just change day to day. They can change multiple times in one day. This is called a rate sheet reprice. If mortgage bond prices move significantly during the day, lenders may issue a reprice for the better or a reprice for the worse. Example, if mortgage bonds drop by 0.50% in price, lenders may increase rates immediately. This protects them from losing money when selling the loan. Mortgage rates are heavily influenced by the U.S. Treasury yields, especially the 10-year Treasury bond. But they are not the same thing. Mortgage rates are usually about 1.5 to 2.5% higher than the 10-year Treasury. Why? Because mortgages carry additional risk, including prepayment risk, credit risk, servicing costs. So lenders watch the 10-year Treasury as a directional indicator, but mortgage pricing ultimately follows mortgage-backed securities. Many people think the Federal Reserve sets mortgage rates. They don't. What the Fed actually controls is the federal fund rate, which impacts short-term borrowing. However, the Fed can influence mortgage rates by buying mortgage bonds. During the pandemic, the Federal Reserve purchased trillions of dollars of mortgage-backed securities, which pushed mortgage rates to historical lows. When the Fed stops buying those bonds, rates usually rise because private investors demand higher returns. Why two people get different rates? Even on the same day, two borrowers might receive different mortgage rates. That's because lenders adjust pricing based on risk factors. These include credit score, loan-to-value ratio, property type, occupancy, and loan size. For example, a borrower with 740 credit score, a 20% down, single-family home, will usually receive better pricing than someone with a 660 score, 5% down, condo purchase. These adjustments are called loan level price adjustments, or LLPAs. Mortgage lenders don't just pick random rates. They make money through something called margin. When they sell a loan to an investor, they receive a premium. Example, a loan amount of $400,000, an investor price of $101. That means that loan sells for $404,000. That extra $4,000 covers operations, salaries, compliance, profit. Different lenders have different margins, which is why rates vary between companies. Inflation is one of the biggest drivers of mortgage rates. Investors demand higher yields when inflation rises because inflation reduces the future value of money. So inflation expectations increase. Mortgage bond prices drop, which means mortgage rates go up. That's why economic reports like CPI, job reports, GDP data can cause mortgage rates to move immediately. So the next time you hear someone say, mortgage rates went up today, now you understand exactly why. Mortgage rates are determined by mortgage-backed securities, bond market investors, treasury yields, inflation expectations, risk adjustments. And every morning, lenders build rate sheets based on what the bond market is doing. That's why mortgage pricing changes constantly, sometimes even multiple times per day. If you found this helpful and want to understand how lenders actually approve and price loans, make sure to subscribe. On this channel, I break down mortgage underwriting, loan approvals, interest rate pricing, real estate financing strategies, so you can understand how the mortgage system really works.